all eyes are on the US Federal Reserve as it is widely expected to cut interest rates by 25 basis points tonight, lowering them to a target range of 3.75% to 4%. In its September meeting, the Fed had already reduced rates to 4% to 4.25%, signaling a gradual shift towards policy easing. Let's go across to my colleague Jasmeet now for more details on what's expected.
Well, as rightly mentioned earlier, given the market and what brokerages feel, they're divided among the rate cut. Most of them are very certain about the rate cut, but the still market stands divided on this particular aspect. We also know that the brokers anticipate that Fed might further cut 25 basis point for continued 2 meetings in this particular year itself. While we also see that the focus will be understanding the overall guidance of what the Fed chair is hinting towards, given the recent US shutdown and policymakers having no idea where exactly the economy is moving at this point. The guidance is something very important alongside the rate cut. Now, if you look at the other aspects, the emphasis is more towards the labor market than on inflation, given the Fed has constantly mentioned that they want to increase and make the labor market better for the folks in the US. Now, in terms of the other aspects that will be in focus for this Fed meet would be the overall picture where the government might stop selling the government bonds to increase the money flow in the economy. Well, that's something to watch out for if they cap that particular channel or they exactly stop selling of the government bonds. Well, secondly, if they want to reduce the overall cash in the market or in the government bond and increase the cash in the market, that's something might again happen. While most certainly rate cuts might be seen in this particular meeting that will be held tonight.
Right, Jasmeet, thank you so much for setting up that context. But viewers, to understand the Fed rate cut in further detail, I'm being joined by Peter Cardillo, Chief Market Economist at Spartan Capital Securities. Welcome to this conversation, Peter. Thank you so much for making the time right from New York. My first question to you is, most analysts, as Jasmeet already highlighted, expect a quarter-point rate cut tonight from the Fed. But what is your reading on the impact of the rate cut on US economy, and what's your take on the future path of reductions as well?
Yeah, there's no question that they'll probably cut by 25 basis points. But I think the key to this meeting, obviously, will be the Fed's statement, that is, its communique. And I think there are 2 important factors to concentrate on, and that is whether or not we have a narrower Fed decision as opposed to the last time. And also the language going forward that could set us up for a 0.5% cut in December. So that's going to be, I think, the key to the statement. Also, I believe that we're probably going to get a more dovish group as opposed to the last time, and that is positive in terms of the markets. I think we'll probably see a continuation of the markets reacting positively, and I think that'll obviously be positive for the bond market as well, in a sense that yields should likely come down even further. And so the key here is that we get a more dovish statement. And if that happens, that would be a good indication that due to the government shutdown and due to some of the weakness that we've seen in the labor market, the Fed could be more generous in December and cut by 50 basis points.
So, Mr. Cardillo, you've of course highlighted the chances of consistent rate cut, which is largely expected, but many dangers still lurk over the US economy. What, according to you, are the main concerns of experts who aren't in favor of bigger cuts? Because that's important to understand as well.
Absolutely. And, the problem that we have with the economy is the labor market is certainly weak. It certainly has weakened. And, if you read all the announcements that are being made by a lot of companies, we're seeing an increase in job cuts. And so that is a big challenge in terms of the Federal Reserve. And of course, the Federal Reserve, in my opinion, is closing its eyes to sticky inflation, but obviously needs to make sure that the labor market doesn't weaken to the point where we could wind up in recession. And remember that we're hearing more and more about jobs being cut due to artificial intelligence. And so that's even more of a challenge for the
Right.
Federal Reserve.
Right, Mr. Cardello, because the reason why I'm interjecting you here is because you've mentioned two very important points. In fact, factors that are that heavily influence the Fed's decision. One is the labor market, which is currently poor, and the second is the sticky inflation. You're an expert, and therefore I'd like to ask you, what policy measures do you reckon would help balance both of these?
It's hard. Well, let's put it this way. The new Walsh member probably is going to obviously be in favor of more rate cuts and probably even for a bigger rate cut. And then you're going to have the traditional hawks that are going to perhaps, side what a quarter of a point basis point, but reserve cautiousness. And so, it's hard to tell who's going to change their minds at this point. But again, I think we'll probably see an increase in more members agreeing to a Fed cut, obviously, in supporting the labor market as we previously saw.
But everyone has also been talking about the lack of government data not really helping with policy decisions. Now, how do you think policy pivots would be executed once data does arrive? Because of course, most of the decisions that are being taken now are in view of what is present today. But once the data comes back, how do you think it could really shift the scenario?
Yeah, that's a good question. The question is, how will it shift the scenario? It could either shift it to a more pessimistic viewpoint or a more optimistic. It's hard to gauge because we haven't seen any solid macro news come out of Washington. And next week we'll be looking at the labor report. And obviously, if the government is shut down, we're not likely to get it. And so we'll have to rely on, at least give us some sort of an indication on the private sector, on the API, which, may or may not be right or accurate, I should say. And so we can only go onto hang our coats on to certain indicators that have come out, but the solid ones, the ones that really gives us a picture of what's actually happening in the economy right now, is a guessing game.
Right. Mr. Cardello, the Fed also holds $6.6 trillion in bonds, mostly US treasuries and mortgage-backed securities on its balance sheet. Now, this huge pile grew during the pandemic when the Fed bought bonds to pump money into the economy. Now, the Fed is shrinking that pile through a process called quantitative tightening. Now, when do you think will the Fed really stop this process? Very quickly.
I think there's a possibility of a hint in today's from today's meeting. I think the balance sheet could be mentioned, and we could begin to see some reduction. And, that would be another key point for today's Fed meeting.